as I'm joined live now from Hong Kong by Michael Buchanan. He is Chief Asia-Pacific Economist at Goldman Sachs. Thank you very much for speaking to us. So we're talking 9.6% growth in the third quarter. What do you take away from this data?
Well, I think what it's telling us is that China has indeed benefited from what we've called a stealth easing of monetary, fiscal and infrastructure policy since mid-July. Yes, maybe at the margin, China is taking a little bit of a step back from that, which I'm sure we can come back to in terms of the reserve requirement interest rate changes. But fundamentally, what we've got here is, I think, a very strong sequential growth picture. Growth picked up quite strongly in Q3 compared to Q2 when it was well below trend.
How much of a threat is inflation right now to the economy in China, particularly in light of the recent interest rate hike?
Well, inflation's certainly been stickier than we had initially hoped. It's been driven primarily, of course, by food prices, but the component of food prices that's doing it has changed a little bit at the margin. But importantly, what we're seeing here is an inflation print that, yes, has ticked up to 3.6%, but it is still meaningfully below the kind of 4% threshold that we think would be, what would be required to really force through a change in the relatively accommodative stance that China has been running in terms of macro policy since mid-July.
So what is
I think
that?
The interest rate and...
Sorry, I'm sorry, I was just going to ask you what that means for policy going forward.
Well, I think that as long as inflation does remain below 4%, I think policy can still be fairly accommodative. And so, it is important that inflation is well behaved. But I think policymakers understand that the blip up in headline inflation is fairly temporary and that underlying core inflation is still coming down. Now, the focus, of course, has been on the interest rate and reserve requirement changes. But really what we have to remember is they are not the binding constraint on bank lending and hence aren't the primary tool of monetary and macro policy at the moment. It's much more important to look at the overall lending. Now, that went up very dramatically in the first part of September, got wound back a touch towards the end of September, but we still ended up nearly $600 billion for the month. And that, I think, is testament to the relatively accommodative macro policies that are being run by China at the moment. So I would look much more at the credit numbers and what the banks are being told by the banking regulator, the CBRC, rather than at the interest rate or the reserve requirement hikes.
And do you see evidence, signs that the economy in China is starting to rebalance?
In terms of the shift towards domestic demand, well, certainly, when you look at the year-on-year retail sales, they're very, very strong. So that's encouraging. Wage growth has been very strong, so that should lead to strong consumption growth going forward. The sequential retail sales numbers that we just got today are, at the margin, a tiny bit disappointing, but they're so volatile it's hard to be sure really what to make of that at this point. And the fundamental picture for strong consumption growth still looks to be intact. Now, of course, there will be a little bit of a shift away from reliance on some components of the investment spending that we've seen since the policy stimulus got underway in early '09. But overall, I think the domestic demand strength in China is very much here to stay. So that should help with China's and the world's rebalancing.
And Michael, if I can ask you about the Yuan as G20 finance ministers gear up for their meeting in South Korea, the US consistently saying that China's currency is very undervalued. Can the economy withstand further appreciation?
Well, yes, I think it can. I mean, of course, we have a lot of different models that try and get to fair value. But the fact that China is still running a relatively large current account surplus, even as demand in the rest of the world is fairly weak and their domestic demand is relatively strong, I think is testament to the fact that, at least in that very long-term sense, the currency is still undervalued. Can it withstand a move? Well, yes, I think it can, but of course, China will do that very gradually, and so that's what we've been forecasting. Really since the start of the year, we've been looking for a 5% annualized pace of appreciation starting in June. And that still seems, roughly right. Maybe it's a little bit faster right now to take account of the political considerations, over the IMF meetings and ahead of the G20. But I think that sort of gradual pace of appreciation is what we're most likely to see. And I think the Chinese economy can certainly withstand that sort of appreciation. But let me just add, one thing, that I think since the IMF meetings, the focus is going to switch to being much more about the broader current account adjustment that the countries are delivering. And in that sense, the strong nominal wage growth that we're seeing in China is at least, if not more important, than the small changes in the currency.
Well, it's good to get your thoughts, your insight. Michael Buchanan, Chief Asia-Pacific Economist at Goldman Sachs.